In this video, we'll look at the basics of a hedge fund versus a mutual fund. Stay tuned. Hey traders, a very warm welcome to you. Okay, so mutual funds, hedge funds, are they the same? Are the difference? What are the main things we want to look at if we're considering putting our money with any of these type of assets? Or not really assets, they really are managed. They're both managed by a fund manager. So somebody is there deciding to pick stocks on your behalf or pick trade ideas on your behalf. So in the case of a mutual fund, you invest with a fund who the portfolio manager there you believe has a good knack for picking the right stocks that are going to increase in value the most for your money. So if you're putting in $10,000, 10,000 euros, 10,000 pounds, the reason you're using a mutual fund is you believe that they're better at picking stocks than you are. So your 10,000 goes in, he allocates that into each individual stocks that he believes are going to perform the best over the total amount. Obviously, they've got under management. It's not just looking at what you've got, goes into the pool and they decide, hey, how they're going to split up their portfolio. And that's why you would use a mutual fund instead of doing it yourself, because you believe they are superior in the market all the time and they're going to get the best returns. Does it happen like that all the time? No, it doesn't, but that's the theory behind it. Okay, hedge funds, again, they're actively managed by a hedge fund manager who will look and who will decide on where to allocate capital to different trade ideas. So this is where they kind of start to differ now. A hedge fund can go short. In other words, they can be buying one stock and shorting the other. They've got multiple different ways that they can express an idea. And it's the same with options. You know, hedge fund guys can use options. Pretty much they can do what they want within reason. In other words, you are giving them money and saying, hey, whatever you can do to make money, that's fine. If you think the stock's about to go bust, then you short me, a massive amount of stock and you leverage it right up. If you think that there's a good opportunity here with some sort of arbitrage play, then please do that. If you think there's an opportunity here with an options play, then do that. And so there's far more flexibility there for a hedge fund manager to do whatever he perceives is the best way to make money for the fund in total. In general, should I say. Mutual funds far more geared up to picking things that are going to rise in value over the longer term. And a lot of people have those in for like college funds, retirement funds, all that kind of stuff. So they don't want the highly leveraged, much more risky hedge fund type model. And the thing as well with hedge fund guys is that you cannot put in you can put a reasonably small amount of money in, but the point is there's a barrier to entry there. You have to be specifically accredited investor, have to have a specific net worth, have to be experienced. Depending on the jurisdiction you're in, there are lots of different barriers or check boxes that you have to have before you can invest in a hedge fund. Mutual fund, pretty much anybody can put in a small amount of money and it just goes into the fund and it goes into the part of the big pool and you just get a small portion of that big pool. So that's something to bear in mind, and that's really to protect people from getting involved in stuff that's ultra high risk, because some of these hedge funds are very, very high risk. They've got a risk of ruin. Very rarely do we see mutual funds going to zero because they've got less leverage. They're just looking for, growth. Yes, they do obviously have down years and bad spells, and you have bad mutual funds out there. But generally, because they're not being aggressive, they're not doing some of these aggressive strategies, the money's a little bit safer. Strategy, they can do, again, whatever they want. We talked about this earlier. Hedge funds can do pretty much whatever they want. It's their discretion. They will kind of give you a broad idea in the brochure, in the kind of investment fund description as to what they're doing, but they kind of have got a little bit of flexibility in terms of what they can do. Mutual funds, on the other hand, have to tell you, hey, we invest in so-and-so stocks, it's a tech fund, or it's this fund, or it's that fund, and they have to stick to the strategy they've outlined in the kind of prospectus, if you like, as to what they're going to do. They can't kind of swing and go off piste to do something that they never planned on doing, or never thought they were going to do. You're investing because you believe that's the risk tolerance level is X, and they should deliver that, whether the performance is positive or negative. And fees, hedge fund guys, mutual fund guys, very regulated with the fees. There's a lot of restrictions depending on which country you're in as to how much fees they can charge, and the fee structure, and making sure they're not charging too much for doing too little. Hedge fund guys is pretty much performance-based fee. You hear the classic 2 and 20. In other words, you get 2% management fee, 20% performance fee. So if they make you the money they make you, they take 20% off that. Plus they take the management fee as well, and that can be adjusted and it's basically on a supply demand basis. If they're really performing well, they may well increase that performance fee, reduce the management fee, or play around with it. Again, it's just an agreement between you and them of what they're going to pay, or what you're going to pay them, sorry, based on their performance and the management and the decision you have to make with that. Whereas mutual funds, a little bit more structured, a little bit more care and protection from the government organisations and the kind of governing bodies around that. So really, this is for the average guy on the street. Mutual funds, people who want to get involved with some sort of exposure to the stock market would do that. Hedge funds, a bit more wealthier, people looking for a bit more return, a bit more risk, a little bit more of a juicier flavour, if you like, with the things they're getting involved in. All right, guys, hope you enjoyed the video. See you in the next one. Take care. Bye-bye.